Hello.
The one water.
That say.
Shall we start? Can you guys hear me? Hello, testing. Testing. Can you guys hear me? Shall we start? Okay. All right. Thanks everyone for being here physically, especially that Christmas is coming. Can you guys see the screen? I hope so. But regardless, I'll send the slides for you to review after this. So a little bit about the context, a little bit of context. Oh, okay. Sorry. Welcome to the people who's online. Appreciate the people who are here physically today to kind of just sort of spend some time with me, learn about some of the RWA projects. So a little bit about me, if you guys weren't there in the first session. So I was born and raised here in Da Nang, Vietnam. Spent the last couple years outside of Vietnam. I've living in Singapore right now. Working at Fireblocks, an infrastructure, a wallet infrastructure and custody solution providers for institutions. And a little bit, if you, I wanted to, before we go into it, I wanted to walk you guys through a little bit of the main topics that we'll talk about today. So the first part, a little bit of context and recap, especially for those who weren't here, who were in the first RWA session that I hosted in October. And the second part that I want to talk about is on the key assets or asset classes that are currently being tokenized very commonly. The third part, originally, I wanted to talk about the third and the fourth parts. Originally, I wanted to talk about more of some of the success and failures. And I kind of realized that it wasn't really fair just talking about what is being successful and what is being, what has failed. So that I pivot a little bit to talk about some of the, successes or stories that have sort of been deemed at like the initial success of RWA. What are some of the failures and what are some of the lessons that we can learn from them? And the fourth part, instead of talking about like success story, I want to talk about featuring some of the startups doing RWA tokenization in Southeast Asia. And the last part is just Q&A or any concluding remarks. So on the first part, regarding what we talked about last time, the first thing was, I think we kind of came based on a lot of trends, numbers that we saw. It's pretty clear that RWA asset or RWA tokenization is on the rise. If you look at the first graph, it shows you all the assets that were, being tokenized from the beginning of 2019 to 2025. And you can see that like from 2019 to 22, there was like basically nothing. And then the last, 4 years, you can kind of see a rise. And this map is basically like a zoomed in version. If you can see from like the starting of 2025, which is this year, to the end of this, like November this year, you can kind of see that when we started in January this year, it was about slightly less than 20 billion, and now it's almost 40 billion. So that's almost double in just 1 year, right? And that's sort of like all type of asset from private credit, treasury debts, commodities, stocks, etc., which we'll talk about in the second part. And before moving to the second part, I wanted to kind of show some of the statistics beyond just why it's relevant for APAC region, why it's relevant for Southeast Asia. So I'm sure you all heard of like the Chainalysis Global Crypto Adoption Index, which has been going on for the last 6 years. So every single year, Chainalysis, which is an AML and KYT provider, they publish a report that talks about what are some of the key countries that are adopting cryptocurrency, adopting digital assets, alongside with some other key relevant trends. And if we look at the latest reports this year in 2025, we can see that APAC is the fastest growing region with 69% year-over-year growth. And if you can see all the countries that I kind of square or circle, we can see India, Pakistan, Vietnam, other Southeast Asia countries include Indonesia, Philippines, Bangladesh, kind of not really Southeast Asia. And then there's like neighboring country to Southeast Asia like Korea or Japan, right? And then, so second part, that leads me to the second part, which talk about, if you can look at it, they kind of list out some of the key assets that were being tokenized in the last few years. So this part, I decided to talk a little bit more about what is actually being tokenized. Okay. So the first thing first, everyone know about stablecoins, right? And stablecoin are actually just money or currency being tokenized. And I'm sure you guys have heard of USDT or USDC by Tether and Circle, respectively. And why is it important? Why does it matter that currency or money are being tokenized today? The way that most people see it is that you have the ability to move liquidity across chain without the sort of the hassle and the difficulty of like handling actual money. Because of that, it's faster, more transparent, etc. And that's why people are using mostly USDT and USDC as a core liquidity across different countries, or as a settlement rails for cross-border payments, right? And I think because of that, stablecoin has sort of become like the poster child for like digital assets because of its success. In the last 1 year, I think almost everywhere you go, and probably a lot of social media posts, you see something about stablecoins, right? And I think there's a lot of jokes running in within the industry saying that stablecoin could cure hunger, poverty, whatever, to that point, right? And if we look at this map, sort of this graph made by Visa, I'm sure you guys heard of Visa before. We can kind of see the sort of stablecoin supply has changed a lot over the years. Obviously, USDT and USDC still dominate the market a lot, but we're seeing more sort of like newcomers coming in, like Ripple with RLUSD, PYUSD from PayPal, the payments company in the US, USDP by Baxo, etc. Right. So that's not what I want to talk about today, because I think a lot of people have sort of talked about stablecoin, which bring me to the lesser known or like lesser talked about topic around like other asset and I think in some cases people don't even consider stablecoin or money as the RWA, but in reality it is a real asset, right? What I actually want to talk about today is more of like the other type of assets. So this map from RWA.xyz, just to be mindful that all these numbers might not be the most accurate. I think just because of like the fragmentation of like the tokenization space, it's really hard to collect data, but just kind of use this as a reference. So the top assets that have been tokenized in recent years, right? So if you can look at this, US Treasury debts stand out as the most common instrument. Others are commodities, private credit, public equity, private equity, which I'll talk about shortly in this. So the first part I want to talk about, which is the largest category that you see in this, is US Treasury. Sorry, that's not. It's actually like under, I don't know why it's not here. I don't know. So the first part is actually fixed income, which typically refers to government or treasury debts. Quick question. Any of you guys know what is a treasury debt or like government debts here?
So it's the money the government issues. So I give the government money, and they give me a piece of paper, right?
Yeah.
And actually, they add more money to circulation.
Okay.
They have to do whatever they want.
And why would I want to buy like government treasury or debts?
Because they promise they will give me some yield sometime in the future.
And how is it better than, let's say, me lending money to a random stranger on the street?
It's different because the stranger on the street, they don't print money. The government actually they have the power to make sure that they will give me back the money.
Okay, so basically they have a strong reputation that will pay you back the money, and that's why people buy treasury debts, right? And one thing about treasury debt is that they typically actually the interest rate is lower just because of the lower risk, and almost always that people will get paid back, right? So I think that's sort of like the underlying characteristics of fixed income or government debt, and because of that, like the low risk and the high liquid underlying asset of these instruments, it makes it relatively easy to tokenize on chain because people already kind of know that this is the promise, this is the income, this is the interest that they're getting back, right? Other consideration include it's pretty stable. The interest is pretty predictable, so it is pretty. You don't have a lot of sort of legal implication around these fixed income because you get paid your income and then you get it back. So instead of like doing it with a piece of paper. So typically when, let's say you borrow like a US Treasury bill, traditional sense, right? They actually give you a piece of paper which allow you the right to redeem the the interest. And then finally at the maturity day, which is when, let's say you lend them the money for 5 years, in the end you get your money back. With tokenization, instead of like you getting the money payment in, let's say, to your US bank account, you just get in USDC or USDT, depending on who you buying the tokens from. And because of the nature of sort of like the predictable payments income of these government debts, they actually sometimes can be used as on-chain cash equivalent. So sort of like stable coins because of like the low risk and low volatility nature of the assets. Yes.
When I think about it, I still think it is very crazy because the thing is that there's no KYC or anything. Because the thing is like, if I come from North Korea, right, I cannot buy US Treasury because it come from a sanctioned country. But I can come from North Korea, I can hold stable coin.
Yeah.
How can that happen? Because because like whenever we come to real world asset, KYC and whatever kind of like legal complaint is the number one thing that we have to deal with. But in this case, there's no kind of like nothing. Nobody talk about it.
So basically, part of the question is who buys it and how can they buy it, right? I think a couple of reasons. For some people, it could mean if I actually put this note here, a lot of the time the user actually, instead of like retail buyers, it's actually like stablecoin issuers or companies that want to have like a crypto treasury strategy. So the first part, stablecoin issuers in certain country or in certain like sort of regulation regimes, companies are required to back additional assets on top of like their cash reserve, and like treasury becomes a pretty important part. So that if, let's say, I'm just making this up for the sake of like example. In certain country or in some circumstances, if I want to issue one stable coin, not all the time that I need to have one US dollar, right? Sometimes the government is like, I don't trust you enough. You don't have enough reputation in the industry. Can you hold additional asset just in case that, something wrong with the company or you default? We have additional things to take back and like distribute to your buyers or investors. That's one way that why certain companies buy it. The other is crypto treasury, which is a pretty common topic. So some companies, actually most of the companies in the world, they sort of have what we call a treasury, which is money that they hold and don't have a long-term plan. Don't have a short-term plan to use it, right? And some company want to keep treasury debts, or they want something more flexible because they want to buy and sell it more in a more, I would say, flexible way, which is like I want to sell it overnight over the weekend, and sort of tokenized treasury debts allows them to trade it more efficiently instead of if they hold on to like the piece of paper and they want to sell it over the weekend, or they want to sell a large amount, it might not necessarily be very easy on, let's say, a centralized exchange, like centralized Web2 stock exchange. Does that kind of answer? So it's rather than like your specific example of, let's say if I'm in Korea in the KYC part, it's rather, I wouldn't say most retail user would kind of go this route just because I can already use stable coins. What's the difference in this? Any other question on like fixed income? All right. So second part, which is an extension of debts, what we call private debts. Does anyone so a quick definition of private debt is that you do not loan this money from a bank, is not public. Not public meaning that you cannot publicly trade it with anyone else. So quick example, let's say I lend someone money, or let's say I'm a company, I'm an investor and I have a bunch of money that I want to lend out, and I want to lend it to another company so that they can build a company or they need capital, right? I don't borrow it from a bank because, for example, some banks, they have really high risk and they don't want to lend to me or lend to that company because that company is very likely to go bankrupt, right? Other reason are like their maturity rate, their requirements just don't work out in the end. That's why some company or some people go to private lending instead. So some of the characteristics of these private credit or private debts are, first of all, because of the nature of it, it's pretty illiquid, which means because you cannot trade it publicly, which kind of contributes to the illiquidity of things. The second thing is that because it is a set agreements between the lender and the borrowers, it typically needs to be held to all the requirements, would include if you want to lend it for 5 years, you have to pay me back in 5 years, right? The other thing is that sometimes it's really hard for the lenders to transfer the debt to someone else just because of the restriction of the agreements. In terms of like why these are the strict restrictions, ultimately it kind of boils down to what is the agreements between the buyer and lenders. Yes, they can make it more flexible, but that comes with extra legal complexity, that comes with extra legal obligations, right? And it might not necessarily be worth the hassle of like making it more flexible. Second characteristic that's really key to tokenization is that these cash payments or the income from the interest income are pretty predictable. Let's say I want to lend now, I want to borrow $1 million for 5 years and on an interest of 10%. That means every year I'm getting the same amount of money regardless, which means if you know this month or this year you're getting this, likely that next year you'll be getting the same, right? So because of these two characteristics, it's actually pretty perfect. It's like, nothing is perfect 100%, right? But it makes it pretty fit as an asset to be tokenized on the blockchain. Just so far so good, everyone's following. Makes sense why it makes sense as a asset for tokenization. Okay. So why? Like, what are the sort of like additional things that tokenization offers, right? Just as I said, is not liquid. With tokenization, it provides additional liquidity because now you can kind of take that token that's being backed by this asset and sell it to someone. Because on-chain, less liquidity, less restriction, right? The other thing is unlocking more capital with fractionalization. What exactly does it mean? For example, if I am private credit, used typically come from between institutions to institutions. Because if I need $5 million, I'm not going to go to like 1,000 people just borrow enough money. I would typically go to 1 or 2 lenders and borrow money from them. So small players or retail investor, very unlikely to have access to these sorts of additional investment avenues, right? Because like if I have $100, who want to borrow $100 from me? So with tokenization, instead of, let's say, with $1 million, you break it down to a million token, each token worth $1. And as a retail investor, sometimes you don't have the restriction of like, you have to put in $100,000 to buy this. You can just buy 1 token, 10 tokens, 100 tokens, depend. So that means retail investor, more opportunity to invest in private debt or private credits, right? And also because individually, retail investors, they might not have a lot of capital, but collectively, that means additional capital for the whole ecosystem, for the whole market, right? Other add-on benefits might not be true at the moment, but I think in the future, it would probably be more clear. Operational cost saving, just because, for example, every month, instead of transferring money to someone's bank account, maybe overseas or whatever, you just transfer directly to their wallet, right? And then everything can actually, the payment can actually also be automated, maybe through smart contract, maybe through predicted sort of like advanced payment logic that you embed into the contract. Other legal implication is actually pretty not as complex. Let's say if you want to tokenize equity because it has to do with ownership, whereas with private credit or private debt, it's more of like you getting payment back, and at the day of maturity, I'm getting my money back. That's it. It's not so much about like ownership of the asset itself. It's more of the claim to get paid, right? Transparency, pretty clear. I think everyone talk about the benefit of blockchain offering transparency. Everything is on chain. Data can be tracked. Obviously, I'm talking about these in like an ideal world, because the cost of getting a tokenization project up and running today, as we know, might not be the cheapest, compared to, let's say, if you just create like a private lending business. Okay, so that's on private credit. The second part, the second sort of set of, let's go back to this chart. So we talk about treasury debts, we talk about private credits. Now, this part, why? Because I lump private credit and US Treasury debt together because they kind of consider debts and they have certain common characteristics. Let's talk about commodity next.
Can I pause a minute? I think that the way that you build that chart is based on like the priority that people have to pay on the default, right? Like when I go default, debt is the thing I have to fulfill first. So is that the reason why we go from debt first, right?
No, it's just what is being most commonly sort of tokenized, because it kind of go into like descending order of percentage. So US Treasury most commonly tokenized sort of assets. Second is commodity. Third is private credit. Does that answer?
Yeah, but like, is that the reason why? Is that the reason why debt is like the first thing get tokenized? Because the government debt is like very easy to like it's already there. It's already there, and the second thing is like private credit and debt is kind of like the first thing all of the creditor they have to, that is the first obligation they have to fulfill before anything else, right? They have to pay out the debt before, or I'm wrong?
It could be it. I think you might have a better answer at the end of this section where we talk about all the asset classes. But I wouldn't be surprised if that is sort of like the first order of payments if something goes wrong, if bankruptcy happens. But I think that's be a couple of more factors that contribute to as we go through other asset classes that are being tokenized. So second asset class or type of asset, commodities. Commodities typically refers to physical goods and assets. So some of the common things that we could think about, precious metals like gold and silver, Vietnam is actually a pretty common country where people buy gold and then store it in their house or wherever, right? Other type of commodities like industrial metals, copper, aluminum, could be property like real estate, machine, factories, and other things could include like gas or natural gas, oil. Sometimes people do consider carbon credits commodities, which is quite common. So if you think about it, carbon credit is not technically like physical. It is like a concept in itself. But it does have value in certain country, and that's why, for example, certain country requires their companies to fulfill certain obligation. That means buying carbon credits to offset their whatever carbon footprints that they have. So it does have its inherent value, and for that reason, I do believe why some people include or consider carbon credit as a physical asset or commodities. Right. So let's talk a little bit about why do you think, so now that we kind of know why some, private credit or government debt are being tokenized, what are some of the reasons why you think people would tokenize commodities like gold, for example? Just kind of, let's take gold as an easy example. As a person, what do you think buying gold versus buying gold token difference? Like, what benefits do I get from buying a gold token instead of gold? Yes.
You can buy it with any amount. Like if you have like few hundreds or a few millions dollars, you can buy like a gold token. So for the actual gold, you're gonna need to have a certain amount of money to be able to acquire it.
Okay.
And a lot of process also. And I think so gold token is more accessible.
Yeah, for sure. So that's for the borrowers. On the lender side, why do you think it could be the case? Let's say I owe a bunch of gold and I want to tokenize these gold so that more people can buy it. Why do you think it could be the case for the lenders or the holders of the gold? There's no wrong answer. Let's say if I have 3 billion or 3 ton of gold, how do I make it easier? By tokenizing. Yeah.
So you have 3 tons of gold, so storage is a problem. So for tokenized gold, you don't have to worry about that.
Yeah. So not so much about the actual storage, because the actual gold have to be stored somewhere. It's more of like the physical handling. Let's say if someone want to buy 1 ton or someone want to buy like 1 kilogram of gold in that 3 ton, I don't have to like physically deliver that gold to them. I can just say, hey, this token entitled you to the ownership of this much gold, and I promise you that I would not send or sell or put this gold somewhere else. Obviously, there's still some element of trust, and that is something that we're still trying to solve, and nothing is perfect, right? But yeah, so most of the time it's the physical handling or the sort of like the transfer of these physical assets that makes it harder in reality, as opposed to if you tokenize them and allow people to do it. I think the second part, as you said, is the fractionalization of asset again. So I don't have to put like $1,000 in it. I can just put $100, $10 to be able to hold gold, right? So that's another reason. Obviously, the same goes for industrial metal, same for real estate. Speaking of real estate, pretty common in Vietnam as a sort of investment instrument, right? But what if I cannot afford to have, let's say, 3 billion Vietnam dong to buy one whole property? So what I do, you break down a property and allow people, retail investors, to come in and spend, let's say, a few million on one project, and making sure they know that that project's going to do well. Over the time, it can be seen as an investment instrument, as if you were to invest in stocks, etc. Right? Okay, so that's on that's on commodities. Next part is on equities, which I think people have been talking about a lot. I wanted to divide a little bit on public and private equities for a slightly specific reason, which I'll talk about. But in terms of public and private equity, Anyone kind of know the biggest differences is? What is considered a public and what is considered a private equity or share or stock? Sorry?
Private equity bank.
Sorry? Do you want to take the...
Private equity banking.
What is that?
Bank, JP Morgan, GP.
Okay.
Yeah.
And what is public
You know?
equity?
Private equity banking.
Okay. And then what about public equity? What's the differences? Let's say if I were to say this company is public and this company is private, what does that mean?
I know, understand you.
Okay. Anyone else here? You can try to guess.
Try to guess.
Don't worry. That's
Let me try. So I think public equity is basically you are certified by an exchange. So you cannot have a public equity without an exchange. So you have a stock exchange that certify you. So you go there and you go through a kind of like bank and everything that the people try to sell the equity for you. So it is publicly traded and it's regulated.
Yeah.
So the two things: one, you have to behave in a certain way. You no longer have like company that you want to do whatever you want. This is not your money anymore. Now it's not your money, but everybody else's money, because the people who put the money into it is the one have a stake in the company. That's one thing. Second thing, you have to list in the stock exchange. So that's two part of it. One is you have to work in a certain way. Second, you have to be certified by a stock exchange.
Yep.
And become a public company means that you, I mean, the moment you become a public company, you don't have like the ownership of your companies is owned by other people, and they have a limit, right? I think the limit in Vietnam is 99 people. If a company have more than 99 owners, then it must be a public company. You cannot have a company that like more than 99 people and a private one.
Yeah.
I think that is a difference.
Okay. So yes, I like to think about the easiest way for me to tell the differences between private and public equity, or you can just say public company equity is just basically who owns, like I have a stake, I have a share, I am partially an owner of this company. So public and private company, pretty easy. Public company meaning anyone can actually be the owner. By anyone, I mean anyone can have the chance to become the owner. Whereas with private, not so much. And why is it that public company or public equity, someone can buy it? Just because, as you said, they are listed on a stock exchange or the public stock exchange. Anyone can come and buy one share of that company and then become partially the owner of it, right? And then obviously when you buy, you have certain entitlement, and just because the number of like shareholders or owners of this company, they have to run in a certain way, they are under more public scrutiny. But again, easiest way to understand is anyone can have a chance to become the owner, a partial owner of that company if it's a public company. So some of the common public equities or public companies that we know of are like Apple, Tesla, Nvidia, Amazon, Meta. More recently, some of the Web3 companies that you guys probably have heard or seen of, Gemini and Bullish, what are two top crypto exchanges. They went public early this year in the US, listed, I think, on NASDAQ for both. So that's on public equities. I mean, everyone can have a chance to become the owner. The other side, which is private equity, which is a company you guys probably have used before, probably not SpaceX, but maybe OpenAI and Canva. Stripe is a payments company. Stripe is actually, fun fact, Stripe is the biggest fintech company that is privately owned today. Pretty huge company, and it's funny that they haven't IPO'd. So that's the main differences. And why do I want to kind of sort of like divide the differences? It's actually more of like, if you look at these, because on public equity, anyone can have the chance to own it. It has certain different characteristics as opposed to private equity and why they are being tokenized. With public equities, why some people or why some companies would like to tokenize them. For example, if I'm the US, I'm a US resident, I can buy all these stocks on public exchanges if I'm from a public company, right? But what if I live outside of the US? Typically, you don't have that option. In Vietnam, I don't believe that you do, right? So tokenizing public equity allow people outside of the US, for example, or in other stock exchange, maybe in London, maybe in other part of the world, to buy stocks of that company overseas. Like, for example, if I'm a retail investor and I think this country, like let's say London, US, for example, have certain company in their stock exchange have the potential to grow, I can buy the tokenized stock of these because I don't have direct access to these stocks. And that's why public equity of these companies are being tokenized. As on the other hand, private equity, different reasons why they are tokenized. As I said, not everyone has a chance to become the partial owner of a private company. That means even if I live in the US, I might not even have the chance to buy OpenAI stock, right? So you tokenize it, allowing me to partially own it through a token of a stock-backed token instead of the actual stock itself. Because I think, let's say OpenAI, Stripe, Canva would go IPO really soon, or they would do really well, and I want to be part of that growth. I want to use it as an investment avenue to make more money as part of my investment portfolio. And that's why people tokenize public and private equities respectively. Right. So next, that's mostly the main sort of asset classes I want to talk about. So back to your question, back to Hugh's question about why I was putting like these different assets in different orders, or why, treasury debt or private credit are tokenized more often. Different implication, right? I think I don't have a slide specifically on that. I can talk about it real quick. On usually, treasury debt and private credit, pretty easy, as I mentioned, with legal wrappers, legal complexity, easier because you are justifying saying that I have the claim to this to redeem, not the claim to own this. Ownership is a really complex subject, right? That's why with public or private equity is harder, because if I am tokenizing equity, that means, am I that post question, like I am the owner of that? Do I have a say in that company? Essentially, at the moment, not necessarily, right? If you buy one token of SpaceX or Stripe, that does not necessarily give you the right to own it. It gives you the right to redeem one stock of that from that particular asset manager that owns the company. I can draw it real quick. I don't know if you can kind of see it on the phone. Sorry, people on the stream. Okay. Okay. So with, let's say, public equity or equity, this is traditional equity, right? Regardless of public or private. If I am the owner or shareholder, I have the claim of ownership and how to run the company to a certain extent. Obviously not perfect. Right. So this is the traditional flow. Let's say in the tokenization flow, I'll use a specific example of like private equity. So let's say private equity being tokenized. What actually happened in the tokenization process is actually this private equity would be owned, the shares or the stock would actually be owned by a special company. Sometimes it's what we call SPV, a special purpose vehicle, or just think of it as a special kind of company, right? Or more of a holding company. And this SPV actually own, let's say 1% of this company A, right? So this SPV in exchange or in return, they would actually issue the token. So in a way, this SPV still owns the stock in itself. And if you buy these this tokenized stock, you actually just entitled to claim it from the SPV, not the actual company by itself. So now you kind of see the differences, right? If you own the actual stock, it goes back to the actual company. If you own the tokens, the tokenized stock, you actually go back to the SVP, the company that owns the share of the company instead of owning the company directly. So that's additional legal implication. And question that comes up are like, do I get, if I own a part of the company through a tokenized stock, do I get a say of how the company is run? Probably not. It's probably to the SPV. Maybe you can go to the SPV and say, hey, can you tell the company to do this? Would they do it if you own one token of it? Probably not either, right? So that some of the complications are still being, maybe one day it will, but right now there is no legal obligation for such thing to happen. Whereas in reality, if you actually own a stock or like a share of a company, the company actually obligated to listen to you, right? Whether it's a private or a public company.
So basically, this is the blockchain version of eToro or Robinhood, right?
Yep. You mean the tokenization part? Yes, but then even eToro and Robinhood, they actually also have some part of tokenized. They already tokenized the public and private stock company today. So which is a pretty interesting extension of their existing business model. But yeah.
So I see no difference between tokenized stock and eToro and Robinhood because basically the same.
Yeah. Obviously, I mean, eToro and Robinhood doing extremely well. There are limitations such as Robinhood and eToro are not available in every single country, right? So if I live in Vietnam or like Singapore, bad example, Vietnam, Thailand, and Indonesia, I might not have direct access to these platforms. With tokenization, a little bit more borderless, a little bit more international, because transaction happen on chain. Okay. I hope that kind of answered the question around like why things like equity doesn't really get tokenized that often. They are being done, and I think there are a lot of legal progress going around tokenization of these assets. Other example include like real estate, which I'll talk a little bit about like an example of a project around real estate later. But if you think about real estate, for example, a lot of legal complexity as well, because if you own a token of a piece of real estate, how do you like redeem that? You can't cut a piece of land and give it to the people once they redeem, right? Everyone has to redeem that piece of property for it to be resold, for it to be like value, so I can get my money back eventually, if that is the eventuality that most people want to get to. A lot of complexity around this when it involves ownership rather than the claim to get paid. In the case of public equity or private credit or public debt. Okay. All right. So that's on all the asset class. Sorry. Okay. Next, I want to talk about some of the examples. As I mentioned, at first I want to talk about some failure and success stories. I don't think that's the most fair to most people, and I don't want it to like falsely advertise anything. So instead, I decided to talk about some of the success and failures that we've seen recently. We don't have that. I think a lot of the failures actually come from real estate just because of the complexity around it. Equity actually has not been very common until very recently, so we haven't seen, I don't think we have enough time or data point to say that this project is failed or has succeeded immensely. So a lot of it some of the example would actually be around real estate. Okay, so first two example, real estate tokenization project in the US. The first example is a project called RealT, which runs, I think started in 2019 and ended recently. So what the project is about, so Detroit is probably one of the commonly, very common place in the US where real estate is actually quite expensive. So what RealT did was that they tokenized real estate, certain pieces of real estate in Detroit, and allowed investors to receive rental income. So how it works is that, sorry, I can kind of draw it to. Okay, so let's say I have a building, right? And I want to rent it out. Usually how it works is that there is a company, let's say an asset manager who owns this company. So this one company, and they rent it out to a bunch of people. So person 1, person 2, person 3, person 4. And all these people, they would pay money back to this company in the form of rent, right? So every month you pay like $1,000, for example. Realty, what Realty did was that they actually, instead of like letting one asset manager, they are technically the asset manager, but they come in between, that they tokenize it and allow retail is probably not a good word. I would say like smaller investor. They allow other investor to invest piece of money in this piece of property, and in return, what they get is that they get the rental payments. So these people would pay rental payment into these investor accounts. So that's how it works with Realty. So what they did initially, it was pretty successful. They raised in total almost $2.7 million. And actually, for some time, people think it was successful because the technology actually works. Investor were getting the rental payments at either monthly or quarterly or yearly. So it works, right? And then these investors have the claim to receive the rental income in all piece of the property. What actually didn't work was that there was some claims that was made. For example, the first one is more of a fraud. I don't know if it's intentional or it didn't work out. They sold 39 homes that they actually did not own. So in this case, they didn't even own this piece of land to start with. So that sort of misleading investor. A lot of the properties that they sold is actually like not compliance to certain regulations. So for example, if you want to rent out a home or like a place, you need to meet certain safety or health standard, right? Like it has to have like proper plumbing. It has to have certain like, let's say in certain like state where it's cold, you need to have like heaters, etc. So a lot of these were found to have like violation of safety and health issue for tenants. So that didn't work out. Second project, Unicoin, which is slightly different than Realty. With Realty, they actually tokenize the real piece of the piece of real estate and allow people to invest. With Unicoins, they actually allow people to buy the token, the coins. Sorry, real quick here. So this is Realty. With Unicoin, they have like a bunch of property. So property 1, property 2, property 3, and they tokenize all this. And then based on this, they issued a token called Unicoin. So I think every Unicoin was worth either $1 or $100. I can't remember for sure. But what the claim that was made was that because these coins are backed by actual real estate, it will be less volatile compared to most cryptocurrency like Bitcoin and Ethereum, for example. And people can buy these Unicoin as a sort of like investment currency. Like if I want to buy Bitcoin, but I cannot tolerate the volatility of Bitcoin, so I can buy Unicoin, for example. And the claim is that because they are backed by real assets, it's going to be less volatile as opposed to Bitcoin, which is virtually backed by nothing, right? It didn't go well either. They actually, in their case, it's rather than the technology, it's more with the fraud allegation and misleading investors. So for example, of all these real estate that they claim that they own, and they were valued at about $3 billion. is actually it was found that the real estate that they own was actually only a small fraction of that. So for example, they overvalued some of the real estate. For example, let's say they have a piece of land, and in reality it's worth it's worth $1 million, but they say it's worth $10 million. That's one thing that's really hard to verify the claim, especially if you are just small investor who want to come in and just buy the coin, right? You're not going to go through all the report and everything and do your auditing by yourself. The second thing was that, for example, on top of exaggerating the value of the real estate that they own, they actually also did not own other stuff, there was like $1.4 billion of real estate that they were supposed to acquire or buy. The deal didn't close, so technically they did not own it, and then they claimed that they did. So that's another thing. Other thing was like in their fundraising, they claimed that they have sold like $3 billion worth of token. In reality, they only sold $110 million. They also said that their token will register with the SEC in the US, which in reality they did not. So in this case, it is more of financial fraud, whereas with realty, it's more of like the reality of like the difficulty of managing these physical properties. Slightly different. I know it's a lot of the time it's allegation and there's legal claims that involve, but I think how I see it is that with Unicoin, there's always fraud allegations that involve in a lot of projects. Whereas with realty, I think the reality comes more with the problem of like physical management of properties. One thing that for example, if you look at realty, if you live in a place or you rent a place, and if you have a landlord, you can actually go to them and say like, hey, something in my house doesn't work, can you help me fix? But with realty, it's a little bit harder because who do you go to, right? Because you have so many investors, who do you know who is the owner? So that's another issue. Okay, next, I want to talk about something that's actually a little bit more successful, called Aspen Digital. So Aspen Digital is a project that actually tokenized St. Regis Aspen Resort in Colorado. I think in Colorado. It started in 2018, and at the point, I think it was in 2018 or 2019 that they went to market. They actually successfully raised about $18 million from 150 accredited investors. So note that the word is accredited investors. So mostly in the US, I think that means you need to have a net worth of $1 million, or you have to make more than $200,000 a year as an income to be qualified as accredited investors. So only those people can buy these tokens. And then there's also a minimum requirements of investing $10,000 into the property. Actually, I think it was pretty successful. And for context, St. Regis Aspen Resort is actually a luxury home, which makes it a little bit more less volatile asset, because these are already priced at a pretty high threshold. And it's very unlikely to go up and down a lot, as opposed to real estate that are being sort of like blown up in proportion in the market, right? So what actually works in this project was that there is an actual exit strategy for investors who buy these. So Aspen Digital actually created a secondary market that was available for investor. Liquidity has always an issue, because if I buy the token, how do I make sure that someone will buy it? Otherwise, I can't take my money back, or if I want to sell it, there's no way for me to take my money back. So with Aspen Digital, a secondary market was created for liquidity. So you can kind of trade it much like you trade on a public stock exchange, which was interesting. And I think over the years, people calculated and they actually saw an appreciation of token, which means that they make money over the year. I think in like 5 or 6 year horizon, the token actually appreciated about 300% in value. So there was an exit for investor. A couple of things that were missing. So why I kind of highlighted accredited investor, which here in the case is that you as a retail investor, you can buy it, or if you want to invest less than $10,000, you can't buy it either. So very limited access to investor, which I think sort of broad access is the goal that a lot of tokenization projects want to bring in, because of the higher collective capital that retail investors can bring in. right? Interoperability, which essentially means that here in this case was that their token can only be traded on a particular marketplace, and it was not available in other places that a lot of people have used. Like if you think about like DeFi exchanges, all that stuff. This third thing was direct governance by token holder, which is still an issue, which goes back to the claim of ownership. As an owner, you should have the claim to say how this play is run, whether it's a company, whether it's a piece of real estate, right? In Aspen Digital or this particular project, if I am a token holder, they actually don't have much say in terms of how the hotel or how the resort is actually being run. However, good news is that Aspen Digital is actually entering a second phase as I am speaking today. And I think they are trying to resolve some of the missing pieces that they have. So Aspen Digital is actually cited as one of a very successful project in real estate tokenization, which is a lot harder to be successful as compared to private equity, debt or commodities. Okay. So that's on some of the lessons. For one, I want to just talk about two startups that I've seen doing RWA tokenization in Southeast Asia, and maybe it could be like source of inspiration for some of you guys here. The first one, so as a quick sort of disclaimer, I'm not advocating for any of the startup. If you want to buy those tokens, it is your own decision. You should do your own research before doing anything, buying anything, right? Just want to use it as a source of inspiration. Before I go to the topic, I want to circle back to the commodity the commodity tokenization. Gold is actually a very common type of commodities that was being tokenized today, as some of the reason that we talked about. You look at Tether, Baxo, Magic Docs, see it's a very common, some token that's doing well, and they are actually backed by gold. That means if you buy a piece of this token, it means that you are entitled to claim that particular value of gold that are held in reserve by these companies or by their partner. So why do I talk about it? Because the project I want to talk about is actually doing gold tokenization. They call Aurum Network. And what they do is their mission statement taking verbatim from their website, developing a platform that streamlines the gold supply chain, giving retail the ability to protect the capital by making gold monetization more accessible through the low capital instant settlement on-chain gold trading, mining, cashback, leverage. Pretty wordy. What it actually means is that you can kind of look at the lower part of the slide. The first thing that they do is that they tokenize and distribute sort of gold token. And how does it work? They actually partner with a company called World Digital Gold Bullion, which is a bullion bank in Australia. You might ask, what is a bullion bank? Bullion bank is a registered bank that deals with gold. They only hold gold instead of a regular bank who holds money. So these banks, they buy, sell gold in large quantity, right? So the problem that then become, if I want to access more retail investor, I can't do it because I can't just go to them and give them 1 kilogram of gold. That's not sustainable for my business. I don't have that scale. With tokenization, what they do is, like for example, they reserve a particular amount of gold to Aurum Network, and they will serve as the issuer and the guarantor of these gold tokens, saying that, hey, I have, for example, for the sake of simplicity, hey, I have 1 ton of gold, and I want to give these to retail investor for investment. I would keep these. I promise I would keep them safe. If you want to claim, you can, right? So in that instance, that allows them to issue what they call WDGT, which is a sort of like their token name, and each token actually entitled you to a one gram of 99.99% bullion gold. So if you buy 100 tokens, that give you 100 gram of gold, basically. The second part of that platform is actually what they actually call the Aurum platform, which is a platform for you to buy and sell gold, spot gold. Third-party community network is a marketplace for you to trade with other people. It's also offer you additional liquidity if you want to buy and sell. Because if you want to mint, then minting is actually the primary market activity, or buying directly from the bank or the bullion bank. With the community network, you can actually trade you can trade your gold to other people who need it, or maybe you need more, you can buy from them. Gold API, just basically an API product that allows other companies to integrate our own products into their platform for things like payments. So instead of paying in USD, I want to pay in a token that's backed by gold. Okay, second startup, Pre-Stocks. Some of you probably have heard of. I believe they built, at least initially, I don't know about now, but initially they actually built around the Solana ecosystem. I think the founders are based in Singapore.
Can I ask a question? Go back to the previous tab. How do they do market maker? Like how do they make sure that all the buy and sell order is fulfilled? Is that the company what digital gold bullion is the company do the market making? I'm sorry, it's go into a little bit into detail, but the problem when I think about tokenization, the problem will be like how you do market making. Because now when you do market making, you have to reserve a certain, let's say you have a project, you want to sell a million house. Then maybe you have to reserve like 300 house for market making, which is like crazy. Like how can you reserve 300 house doing nothing? Sit there only for market making. So I kind of like have no idea how they do it.
That's a good question. I will read and we'll find out the answer. I don't have that answer right now. Okay, I'll make sure I find the answer. Okay. So Pre-Stocks. What Pre-Stock does pretty standard, tokenizing pre-IPO stock. What they define pre-IPO, I think the definition of pre-IPO stock pretty flexible, pretty liquid, in the sense that basically any company that have high potential of IPO, right? Which means they very high growth. And once a lot of companies, at the point of IPO, they actually see a massive increase in their valuation. So basically by buying the company for a small price right now, you have the potential of earning a lot more money in the future once the company IPO. So the token backed by one by SPV exposure to the underlying company shares. So as I mentioned just now, SPV, special purpose vehicle that owns the claim or the share of that company, and you basically buy the token from the SPV yourself. Today, they actually tokenize some of the interesting company. OpenAI and SpaceX are two interesting one. Anthropic is the company that owns called AI. Yeah, so I think that's about it for today. Yes, I think before sort of like ending the presentation, just want to say, I think tokenization is still an evolving space in Southeast Asia, in APAC. Just because I think just the regulation around like the sort of like what we call the easy use case around crypto trading are still being formed. And for that reason, I think a lot of people are still not sure of how tokenization will be moving forward in Southeast Asia, just because we don't know what the authority, we don't know what the markets are thinking, right? Not a common concept here. But there are definitely some success story. And I think a lot of them actually have succeeded, or a lot of them are doing well right now by targeting more of like, instead of limiting themselves into the particular country, I think it's smart to kind of like go borderless and offer it to as many markets as possible. So for example, Pre-Stock is pretty much available to most countries except for US sanctioned country and specific country where it's a bit more high risk. When I say restriction, meaning like resident or people who live in that country cannot buy these stocks or tokens. Other than that, it's pretty flexible and borderless. Okay, that's it for my presentation. Okay, I don't know if anyone is watching the live stream, but if there's any question, or maybe there was a question in the middle and I missed it, would love to go back and address anything.
While we wait for the question from the online audience, I think I still have more questions.
Okay,
So
yeah.
how do you define success for real world asset tokenization projects. For example, like one of the success criteria that one of the project development asking us is like, can they sell everything on chain? Is that a success criteria? Kind of like what is the? It's kind of like very difficult for me to answer what is the definition of success of a tokenization projects, because sometimes the project is not nobody buy it because the asset basically not that good, right? Someone bring a property project to us, and we bring the project to a third party, and they say it's actually a very bad idea to bring this on chain because this is already a project that cannot sell in, I mean, traditional finance. Now you bring it on chain, there's no chance. The second thing is like I know about MetaWow. MetaWow is a property tokenization from Europe, and I checked the AI and the Twitter. Everything is still fine, but some friends tell me that they are doing too good. That a company buy them and now they quit Web3. So like they are too success that they quit Web3 because someone just buy the SPV and done with it. So what is your definition of success?
Are you asking the definition of success or the prerequisites to success?
Maybe both.
Because I think it's slightly different things, right? Prerequisites to success was required. Obviously, as you said, if it's a piece of property that no one want to, like people don't want to buy in Web2 already, I don't know why it's gonna make why Web3 is gonna make a difference, right? So that's one thing. Like it's actually it's more about the actual value and market demand, right? That's one thing to consider. I think the other, obviously, like this is just my personal opinion. I'm not saying on behalf of anyone anything, and just take the word with a pinch of salt. I think the second sort of criteria or like things to consider is I think there's two part, or actually a couple part, right? The first is technology. Do you have the technology that works? And if you don't, you might want to rethink it because this is a lot of work, right? Not just the tokenization part of it. How do you make sure that your technology is compliant with the regulation in respective country? So sort of like having a good technology or at least a good technology partner is important. A company that kind of like a technology partner that knows what they're doing if you don't want to do that in-house. Second part is legal consideration. Have you really looked into what is allowed and what is not allowed in your particular country or in the country that you want to target to? So maybe this might not be the most up to date, but maybe for Vietnam, that means if you cannot sell to domestic investor in the country, maybe you can consider selling it to foreign investor as a project in Vietnam, allowing people to own a piece of real estate and make money out of it, or using it as an investment vehicles in the country, in Vietnam, for those who want to sort of like invest more money in the country because of the potential for growth. So legal consideration is second. The third part is, I think just using common sense. Like, does it make sense to tokenize on the block to put, just because everyone talk about blockchain, does it actually make sense to tokenize? Just like you said, right? Why would you want to tokenize a piece of real estate that is already hard to sell in the Web2 market? Or, other things are like, as a logical person, why would you want to put it on blockchain? Like, answer that question. Like, if I were to be an investor, if I were to be a market participant, why would I want to buy this project? I think earlier we talked a little bit about like tokenizing voucher or tokenizing reward points. And the question, if I were to talk to someone who wants to have this idea, is that why do people want to tokenize these? Like, can you give me example, or like, can you give me a reason why people would hold these tokens, right? And if you can't give me an example or a reason, then I don't think you should tokenize this project. I think a pretty interesting example was that I was playing a game for the last few days, and in the game you actually earn certain like cards, like Pokemon card, but not Pokemon cards, like certain collectible cards. And there's a feature in the app that say, click here if you want to trade your card. And when I click on that, it actually takes me to a Facebook group. I think that's a pretty interesting use case for tokenization, because these cards have certain value, and if you have a Facebook group that has no matchmaking engine, why not leverage blockchain and allow people to have a wallet that can be tagged and you can see that who owns whichever car? That makes sense, right? But for like loyalty points, for some people, if you want to tokenize loyalty point, maybe you want to transfer it across different apps. But if that is not your end goal, let's say you are a company in Vietnam and you have certain loyalty points and you just want to tokenize for the sake of it, you're not going to move it somewhere else. Then my question is, why don't you just keep doing what you're doing? Because there's nothing wrong with it, right? So that's on the prerequisite. On the second part around success criteria, couple of things. Obviously, I think everyone, like when you start building something, you probably should think about like yourself as the project owner or as the company who runs this project. What do I want to define as success? Like for example, Aspen Digital, right? Like the project that tokenized St. Regis Aspen Resort. I wouldn't call them a well successful project, but they have achieved some initial goal. Their goal is raise $18 million worth of token through token, whatever, like token offering or ICO or TG, whatever you want to call it. They did manage to raise $18 million from 150 investors. If that is their success criteria, they have succeeded, right? So define what you want to like. If let's say it's a piece of property and it's worth $2 million, and this is your end goal, then it should be your success criteria. Other things are like, do I have a secondary market? I think it's really important because when you talk about tokenization, or actually more of like secondary market is more of like an exit strategy, which I think is part of the reason why Aspen Digital has claimed some initial success. Exit strategy meaning, am I making my investor happy, right? Because if there's no exit strategy, then why would I want to buy a piece of asset? And a couple of things that go with like exit strategy, secondary market or liquidity, right? If no one's going to buy this token from me, I need to reconsider whether I want to buy this token or not. And creating a secondary market is not an easy job. Then a couple of things you need to think about is, do I create that secondary market by myself, or do I go find like an exchange that allows me to list these tokens? And these are very hard tasks. And maybe then in that case, your success criteria is that I want to list my token on sake of simplicity, like eToro or Robinhood or like Bybit even or Binance, right? Because these crypto exchange are just places where you trade token, and these are token. If your success criteria is maybe I want to list on one of these exchanges, yes, then make it part of the success criteria. Yeah, so I will say like those two important things. Yeah, okay. Where do I start with the question? Okay. If we are in Vietnam, just buy index of stock. Or, okay. Is the company backed? Who owns the token SBYX? An example, when you say the company backs, you mean the company name backed or the company is backed as a concept? This is from NH32 Web.
I think that's a real company.
Okay. I haven't looked. I've heard of backs before. I have not looked into it. Like I understand. I know every single company has a different way of like tokenizing. For pre-stock, for example, it's through an SPV. I would encourage you to go to Back's website, and if they don't disclose that information, I would think it's a red flag for me.
So that a company that the token is an SP 500 tokenized ETF.
Oh, okay. Yeah, so I don't have that answer. I don't know who owns these tokens, but I would bet that they would list that information on their website. And if they don't, it is a pretty big red flag as a tokenization project for me. I hope that kind of answered the question.
Okay, the company name is Back Finance.
Yeah, I've heard of it. Yeah, so I would say just go to the website and I'll go actually have a look by myself after
I think
this.
it's really easy. You should go to the website and then they can claim it. Yeah. Okay.
Okay.
But big question for me is like, so in summary, what is the benefit of tokenization? I see that is one is cheaper in operation, right? For example, like bond, and
For certain things, yes.
yeah, for certain things, then tokenization make it cheaper for you to operate. That's one thing. For certain thing, tokenization mean that you have maybe larger distribution, right?
Yeah. Larger access to capital or broader access to capital.
And the risk is like, so that's the two major benefit.
Obviously, like goal, for example, reducing the what we call operational overheads, which mean like physical handling of things. So that's another thing. I think we will talk about transparency too. Like for example, if without, let's say with this model, right, with this like real estate tokenization model, technically these company can just sell like a owner certificate to all these investors without blockchain. But how do I know that how many people are owning this piece of real estate? How do I make sure that this company is being accountable for what they saying that they do? So blockchain actually add on that, additional layer of transparency.
Okay. So I know it's a little bit off topic, but for builders, especially for indie builder, real world assets sometimes a little bit too difficult for them to do because it's a lot of legal complexity in here. What about real world asset but not that real, like time, data and time? What is your pick of that?
Yeah, I mean, these are not financial products, so definitely like bypassing some of the legal complication or complexity would be a lot easier. I think it goes back to the question of like, is there a market demand for it, and does it make sense commonly? Like, are people already buying it? My answer is probably yes, because people are already buying time of other people on Upwork, right? So it's probably not going to be that much difference. But I think some other question that begs is that you do need some money to market your place, right? To market your platform. And do you have what it takes to actually build it from scratch? But I think there's definitely potential for that. And I'm actually already seeing some of the platforms that does this. Yeah, and I think the other thing is that do you actually attract valuable resources, valuable people to the platform? Because let's say, like, I'll just use the example of myself. Like, I'm a no-name person, for example. And if you were to invite me to my platform, I might say yes, but who's gonna buy my time, for example, right? So things like that definitely need to go into consideration. Does that make sense? And obviously it goes the same for like things like music and sort of like creative products too, designing and all that stuff. Similarly, right? Do you attract like valuable resources to these platforms? Do you have people that want to come to your platform? Can you make a user experience that very seamless to the way that people are using today? If not, it's probably quite hard. Yeah.
Because some people in here, like, he's trying to tokenize the idea. People try to tokenize different things.
Yeah.
So the conclusion coming from you is like way the market and how you attract like high value.
Exactly. And think about, I know a couple of founders who spend a lot of time doing research before they go to market, and actually have respect for people. Like, it's important for you to act in market demands, right? Or like when timing works in your favor. But I have respect for people who actually want to take a step back and like understand whether there is a market demand for this, because if not, you might waste a lot of time building something that no one have demand on using in the market, right? And I don't encourage people to tokenizing or make things Web3 just because it's Web3 or just because it's blockchain and it's the thing. It doesn't make sense. Maybe it does maybe some people would have some initial success doing it, but my bet is that it's not going to be sustainable. Yeah. All right. If no other question,
Yeah.
Shall we? Okay. All right. Thank you everyone for being here. Thank you for those folks who are online. Appreciate you guys coming. Probably gonna host another session, but let me know. I'll send the slide to the community group chat after this. The next, just as a food for thought, the next thing I can talk about more in depth about sort of like, instead of drawing chart like this, I'm happy to create a session where we talk about some of the process of tokenizing things, what goes into each of these projects around like legal concern, legal consideration, the technical consideration. Happy to do that. Otherwise, if there's any topic, maybe around payments, which I know things are too, happy to share on that as well. Okay.
As a host, I think the next time I will invite lawyer in because
Okay. Yeah.
will be the one that makes a difference.
Okay. Yeah, for sure. All right. Thank you, everyone. Okay.